Hello, everybody, and welcome to another My Credit Guy episode of Making Credit Common Knowledge, where our main goal is to help you understand your credit and the important role it plays in life. Whether you need a better score to qualify for a new home loan or for any other important purchase, at the end of the day, we hope that the knowledge that we are sharing with you is not only helpful to you, but is also something that you can share with your kids, friends, your family, coworkers, really anybody that's in your social circle, so that we can all kind of hopefully work together to make credit more common knowledge. If you're wondering about fixing your credit or building your score, feel free to send us a message here on our Facebook page or go to mycreditguy.com/u-made-it for your free credit review. Today, we'll be talking about your credit report and, most importantly, 4 big red flags you need to look for, especially if you're thinking about getting into a home anytime soon. Before we get into that though, I want to take a second to introduce myself and our guests. I am Curtis Silva. I am the social media manager here at My Credit Guy. And today we are lucky enough to have with us Amy Colette, our onboarding manager, and also Megan Harrison, one of our very talented onboarding specialists. How is everybody doing today? Amy, how are you? Tell us how you're doing. Tell us about your role. Give us some background about yourself.
Absolutely. I'm doing great. Happy to be here on the Facebook Live for the first one. I'm originally from Washington State, and I moved down to Arizona 3 years ago. I happened to meet the owner of My Credit Guy, Sam Parker, while I was selling cell phones. And so, and it just kind of evolved from there. And I've been with the company for just almost 3 years. Next month will be 3 years. I am currently the manager of our onboarding specialists. So what I do with the company, I'm in it talking with people who are interested in getting home loans. Sometimes people need us for cleaning up for future use, but mainly we're getting people ready for home loans. So I'm doing the reviews and talking to people about what they might need help with, how we can help them, and what to do to get them to their goal of that home ownership. So, and then I, of course, help with the team, and I'm doing some training. Our team's growing, so we've got new members on the team that I work with, and just kind of all around pretty busy right now, and happy to be a part of everything. So.
Busy indeed, absolutely. Amy has been instrumental in helping My Credit Guy grow our team. As she said, we're growing pretty quickly, and she has really stepped up to help us be able to kind of get people where they need to be, train some of our other credit experts. So we're really lucky to have her around. And we also have Megan Harrison here. Megan, can you tell us a little bit about what you do and a little bit about yourself as well? We'd love to hear about that.
Sure. So I am Megan Harrison, and I'm an onboarding specialist. So much like Amy said, calling on those clients that need a little bit of help, maybe need that push to, on the path to home ownership, cleaning up for future use, conventional loan, FHA loans. We help them get to where they need to be, get back to the closing table as quickly as possible. I hail from Belle Plaine, Iowa, also Southern Iowa, Bloomfield area. I went to UNI for a communications degree, and I reside in Elbron. Got 2 kiddos, got a husband, a couple dogs, and yeah, I just like to live life and have fun.
Awesome. Awesome. Well, thank you guys both for being here. I'm really excited to hear what you both have to say. I know that between the two of you, there is a lot of knowledge and a lot of time spent looking at credit reports. So I feel pretty lucky to kind of be with 2 credit report experts, basically. And so to kind of roll into our topic here, before we address the 4 big red flags we want people to keep an eye out for on the credit report, I want to kind of address, why exactly is checking your credit report so important to begin with? Can we kind of address that really quick?
Yeah, absolutely. So your credit report is your report card per se, or what I like to refer to, it's your resume. It says who you are and how you handle your money. So are you a safe bet for a lender? Because they want to loan you money, but they want to know that they're getting their money back. So are you a safe bet? So that's going to determine your interest, whether you're approved or not, your interest rate that's, just basically it shows what you do with the credit that's extended to you and how you manage it, so they can determine what they want to loan you or if they want to loan you money. So it's really important, but it factors in a lot of different areas in your life, from employers to auto insurance. I mean, a lot of people look at your credit. So it's really important to know where your credit's at, what's on there, and make sure that everything is accurate and in good standing. So.
Absolutely. Yeah, there's a lot of things that can go wrong really if there are like mistakes on your credit report, or if you know you're doing something wrong and you don't know it. Like having that information in front of you is key. It's super important. And I also think it's super interesting too, Amy, like you said, there are a lot of different people who do end up looking at your credit report, or at least can look at your credit report. Megan, do you know, like, could you give us some examples of like who would be looking at your credit report and who that information is relevant to?
Yes, absolutely. So those of you, or those people that can see your credit report, view the credit report, you got banks, you got creditors, lenders, insurance companies, potential landlords, is another one, collection agencies, even potential employers, which, you know, if you are going to apply for a bank position or any type of position like that, I just had a client actually come to us for credit repair because they had a potential promotion within their company, but it required a certain score on their credit report. So that is something that is not really well known, but, you know, can also make or break you, I guess. And then of course the government.
Yeah, and
Wow.
coming back to like employers, like certain jobs, you're required to, you can't have a certain amount of collections. You're considered, you know, I mean, you have to be insurable, and certain positions, you can't have collections or a certain amount of collections. And there's different factors that, yeah, credit's pretty big in a lot of areas.
That's insane. For how much we don't talk about credit, those are a lot of areas in our life that really touches on. So yeah, wow. I'm glad we're talking about this. I think it's really important that people, you know, do make a point to check their credit report, understand where that sits at. But I'm kind of wondering, it's like, can those people, like that's a lot of different people that could look at your history. Can they do that without letting you know? Like, do you have to be aware when somebody's checking your credit, or tell me about that.
Yeah, so
Yes. Yeah.
go ahead, Megan. You're fine,
Yeah,
Megan, go
so
ahead.
only if it's a soft inquiry though. So that's the main thing too, because the soft inquiries, they don't affect your score and they won't show up on your report. However, if it's a hard pull, like by a lender, for example, you have to have permission to do that. So even so, with hard pulls, it only impacts about 2 to 3 points. Okay.
Yeah, that's a big
Okay.
misconception. People think that that really hits their score hard when they have an inquiry, a hard inquiry. It's really only 3 to 5 points per inquiry. However, if you're doing something like auto shopping, you're shopping for a car, we as consumers have the right to get the best interest rate on the loan that we're trying to get approved for. So they can put you through to as many banks as necessary to get you that great rate, get you approved. So when you're in a 7-day window, for example, of car shopping, they can run you by as many banks as necessary to get you a good loan. And it's only counting as one inquiry points wise. So 3 to 5 points. And even if they go through 20 banks, it's still just that one inquiry. So you have a window. So when you're car shopping, don't take a week and then have them pull your credit and then come back another couple weeks and do it again and then come back. That'll add up. But
that's a common misconception too, is, you know, a lot of clients think that all these banks pulled my report, it's dinging my score, but in reality, it only counts as one.
Yeah, and that's a real big misconception. And then removing hard inquiries too is something that you want to be, you don't, if you gave permission, then it is what it is. You don't want to do, because anytime you're trying to get a hard inquiry removed, you're opening an investigation as to why that company is pulling credit without permission. And see, if you gave permission, it causes kind of a problem. And then what happens is because the investigation has begun, it becomes difficult to pull your credit when you want it pulled. So if you go to get that home loan and you've been fighting all these hard inquiries, you may not be able to get your credit report to get that loan. So it's really, there's a lot of misconceptions about things like that too, when it comes to your credit. It's definitely
Think of
good
it as
to
like a freeze. They'll put a freeze because
Mm.
they think that it's fraud.
Yeah. So, and that's fraud is another good reason that you need to be aware of your credit report. It's very easy for someone to get your information at times, and then before you know it, you have a lot of things and accounts on your credit that you're completely unaware of until you go to get pulled for a loan and your score's in the low 500s and you're like, what's going on? And you don't recognize half of on there. So it's really good to keep an eye on things because it's surprising how quickly it can take a turn.
Absolutely. I know last week I was on here with April Robbins and Marsha, and we were talking about the disputing process, getting inaccuracies removed from your credit report when something, is inaccurate or invalid. And I read that 1 in 5 people actually has, on average, an inaccuracy on their credit report. And so, I mean, just with that statistic alone, like 20% of people, I mean, do you guys agree that that would kind of like merit just about anybody to stay up to date on their credit report and to kind of to keep up to date with that? Like, that's a lot of people.
Yeah, absolutely. I mean, you have to think about how many Amy's are out in the world. And if we have a similar birth date, some kind of a similar spelling, sometimes things can cross over onto the wrong reports. There's that kind of thing. Also, like looking at your information, I think one of the things we were going to touch on today here is your incorrect information on your credit. It doesn't affect your score, but if you have an address that you don't recognize and you that's in another state, that's an indication either something's crossing over that shouldn't be with some similar information, or possibly someone's trying to open things in your name. So those are things to watch for. They don't impact you negatively score wise, but that's an indication something's not right and that needs corrected.
Gotcha. So number one there, that number one red flag that people should look for, like let's say somebody pulls their credit report, they're like, okay, now what? What should I be looking for? Amy, you're saying that number one is inaccurate personal information. And
Correct.
although that doesn't affect your score, it could be an indicator of fraud if that information is inaccurate.
Correct. Yeah, you definitely want to make sure that your addresses are correct. And people say, well, I don't work there anymore. I want that workplace removed. Well, that's your history. That's kind of like your, where you've been, and it's not a bad thing, and it's not hurting your scores as long as you did work there and everything's correct. If you've had maiden names, those are okay because that's who you were in the past and it's noted. It's like your history. It's your resume. It says who you are, and it helps them to validate things as well because it matches to you. So it's not a bad thing to have that kind of thing. What's incorrect or that you want to watch for is stuff that's not yours or not your name or different middle initial.
Or like the juniors, seniors.
That's always a big
look for. Or like I had a couple that came through that they were twins and they had the similar first name. So the sister's information was on the other sister's report. And we needed to, figure out, okay, how can we get this, straightened out because they had pretty much the same first name.
Is that a pretty messy process to straighten out? Or, I mean,
well,
we see that frequently.
It happens. It's not super messy, but it is a little bit more. I mean, you definitely have to have some more documentation to validate your identity. Normally you're looking at sending in your driver's license and a proof of address, a recent bill. When you have the actual identity misinformation, then we need to have social security card, thing like that, the things that will help. That help clarify things with the bureaus to make sure that they have the right person and they can remove the incorrect information. So it's just adding more documentation.
Gotcha. To prove that what you're claiming is essentially correct.
Correct. And they should correct things once they have that.
So tell me, if let's say I pull my credit report and I notice that I do have inaccurate personal information on there, and let's say I didn't pull my report and I tried to go and apply for a home loan, does that affect my chance of getting a home loan? Like if I do have inaccurate personal information on there?
It doesn't keep you from the home loan. Your scores are good. What could be an issue is when they're going to pull your credit, if your information doesn't match what you're giving, it may not pull the credit report up. Like they may
Gotcha,
have a hard time
gotcha.
pulling your credit report up. If there's some, if you're saying one address and the address that the credit bureau has does not match, you may not get your report. So you'll have to
Or you
call.
may only get like Experian or Equifax and TransUnion not pulling, or vice versa, because there's, you know, something up with the credit bureau where like that information is not correct.
So it just causes all sorts of trouble from the bottom up, basically.
You basically need to make sure your information is correct. And that's what the bureaus are doing their due diligence to make sure that, hey, they're not giving out someone's information. If it's not matching exactly, they're not going to release that information. And so that's for the consumer safety as well. You just want to make sure your items match so that you don't run into issues like that. And that's one of the brings us back to why it's good to check your credit report.
That makes sense. That makes total sense. So then, okay, let's move on to the next one here. We have a couple more red flags we want people to keep an eye out for, so that they know what the important things to look for on their credit report are. Can you tell us about that second red flag, Amy or Megan?
Yeah, derogatory marks.
Yes.
So yes, derogatory marks. You can have, you know, some things that fall under that umbrella, if you will. Some derogatory marks would be like late pays, collections, charge-offs, bankruptcies. The thing with bankruptcies is you need to make sure that they're configuring into the score accurately, which can go into like the MLP rating.
So with a bankruptcy, there's usually a lot of errors afterwards. So you want to definitely go through and make sure everything's reporting correctly. Once, depending on the type of bankruptcy you're filing, but like a Chapter 7, when creditors are realizing they're not receiving their funds, the money that's going to be that they were supposed to be getting, there a lot of times they won't update the status of that account correctly. And so those are things that need to be, because the MLP rating that Megan mentioned is a numbered system that tells basically the worst is the 9. It's a collection charge off, and so a bankruptcy then has its own rating too. And so just the little number difference does make a big difference in your score. So we look at things like that as well to make sure everything is accurate.
And we do, yeah, like Amy said, we do see a lot of those errors after a bankruptcy has been dismissed because they're not updating that status. And, you know, we want to get that removed, if not updated to a better status, a bankruptcy status.
It's really important in your score.
So that MLP rating system you're saying basically just kind of tells you the severity of the derogatory mark, or or is it just a classification like type?
It's like severity.
It's a number system that breaks it down. So R1, for example, is on time and good standing, and that's what you want. Oh, okay. So, and then it progresses up like to 9. There's like a extended number system. It gets rather complex, but that's something that you can leave to the credit experts, because we'll definitely take a look at that in our process as well.
Definitely. And so somebody should be looking for like all ones then. Like that's what you want when you're going down the line. Yes. You want all those ones. The one is the number to look for. Gotcha. Yeah.
Current and good standing. That's where you want to be at. So you're looking for things like negatives that are like late payments. Late payments are huge. We'll talk about that in a second too. You're looking for collections, charge-offs, you know, things that are inaccurate, accounts that you don't know about. There's things that, or accounts that maybe have been like a data last activity on a collection. That's a big part of your score too, because the older those get, the less they're impacting. And actually, you know, as you may have learned in some other videos of ours, when you pay a collection, you actually drop your score because of that data last activity. So there's a lot to look at on your credit report. That's pretty important.
Well, no, the whole charge-off thing too, I feel like that's a common misconception, that clients feel like that debt's been charged off, so they feel like they don't have to owe that debt.
No, there,
that
Megan.
Debt is still
that's a big one.
Yours. Yes, that debt is still yours. You are still responsible for that debt. A charge-off is basically a collection with the original creditor.
And on a charge off, why that you still owe it? Basically, a charge off is that company is saying that I'm taking this money as a loss. And so I'm not having to pay taxes on it on my taxes because they haven't received the funds. So they get to say that for their taxes and they don't pay the money on it. That does not mean that they're not still collecting the debt. So once they've received the money for the debt, then they would update that with, and pay the taxes on it. But that's the premise behind a charge off, is just saying that I'm not having to pay taxes on this, but it is still a debt that is owed. So that's a really good one, Megan.
Yeah, that's perfect. Somebody, Tina down here just left us a comment and asked that very question that you guys just answered. She asked, why does paying off loans, or no, I'm sorry. This is actually a little bit different. That's my fault. It's Tina asked, why does paying off loans early sometimes ding your credit score? Would you guys be able to answer that for Tina?
Yeah, because you're paying, if you pay off that loan early and that account is closing, you're losing all of that payment history. And I don't know if Amy wants to add to that, but that's why your score can drop.
So yeah, you're losing the pay history. It's no longer an active open account. However, the drawback to that too is if you have a late in the last 2 years, unfortunately, that's still going to count against you for 2 years. But the good on-time payments that you had with that account aren't factored into your score. So you do take a dip. So when it comes to like auto loans and things like that, you want to make your minimum payment because you're getting points for being on time every month and how long the account's been open. It's adding to the length of your credit history, which is a big part of your score too. So yeah, definitely keeping those open. It doesn't benefit you to pay off an auto loan early unless you need it for debt to income ratio issues paid off, or you have a very high interest rate and it makes sense financially, obviously, to pay that off. Otherwise, it is actually, part of your resume on your credit. Then it's helping build that up. So that's a great question. Was it Tina?
Yeah.
It was Tina, yes.
Great question.
And then, we just had another one come in. From Diana, she asked, why does paying off collections decrease your score? I guess we just went over that, but would you guys want to briefly summarize that? Yep, data last, okay.
The data last activity gets updated to the date that you paid it, which can sometimes cause a dip in your score. It's like opening a new wound, and that wound needs time to heal.
So collections, when they're on your credit report, the older that they get, the less impact they're having on the scores. And then 7 years is when they're supposed to come off, right? So a collection, whether it has $1,000 balance or a zero balance, in the scoring algorithms, it is a collection. And so the data last activity is what's really important here, because if it's today's date, it's fresh. It doesn't matter if it's a zero balance, you've just paid it, you've reactivated that data last activity, it's fresh. So now you have a brand new collection in the scoring algorithm's eyes, and that's why you lose points. So it's best because it's a misconception that once a debt is paid, that it comes off of your credit. It does not. This is your resume that says your credit history. So you had an account in collections, and now it's an account that's been paid that's in collections, and it's fresh. So until it gets 7 years old. So that's why it's really important to get that removed and when it's paid as well. And that's something that we can help people with.
Let us help.
Absolutely. Always. We are here to help always with any credit questions you have, or like I mentioned before, if you do need a free credit review, you can always reach out to us through our Facebook page. So please don't hesitate to do that. So, okay. Moving on, we have 2 more red flags that we want to highlight for you guys. The next 2 that we are going to be talking about are 2 that we consider to be very, very important. We'll save the most important for last, so stick around for that. But number 3 here, Amy, can you lead us into that, please? Thank you.
Utilization. So utilization of your cards is the second biggest factor in your score. So where you keep your balance in regards to the limit is heavily impacting your score. So if you have a lot of nice lines of credit, so your credit cards for your revolving lines, they're helping you out. You have several nice lines. They've been open for years, and that's great. But if you have a credit limit of $1,000 and you have $900 on it, unfortunately, that because it's such a big factor in your score, that's really holding your scores down. The bright side of that is that's the quickest way for you to gain points, is pay those balances down on the credit cards, because your utilization is really important here. And can get quite a few points by paying down credit cards. So here's the thing with anytime you're over 50% of your limit, you're losing points. If you get closer to the limit, you're losing more points. And if you go over your limit, you're losing quite a bit of points. And then we always say, getting them down obviously below 50%, so you stop that loss, but 30% is good, 10% is best. And that's the thing, is that each line is scored individually. It's a misconception too, because you are scored on your utilization overall, but they do look at each line individually. And so you have a chance to gain, lose, or not get any points. And that's all determined one day out of the month when it reports. What that balance is on that date is going to factor into your score. So keeping nice low balances is what's going to add points every month to get those scores up there.
Each creditor is different on when they report too. So you have to keep that in mind, because all update on different days of the month.
Yep, that is true. Yeah.
Okay.
You can call your creditor and find that out. Sorry, Curtis, go ahead.
No, that's okay. I was just gonna recap that. So like if I have a credit card and it's my limit is $1,000, anything over, if I have 500 charged on that, $500 on $1,000 limit card, anything at that or over that is hurting my score.
Mm-hmm.
And ideally I would want to keep that at $300 or less to benefit my score. Ideally between like 6 and 10% though is like optimal, right? Okay.
Yeah, that's the optimum, where you get the most points. If you carry a zero balance and pay it off every month, that's not helping you either, because the credit bureau sees it as inactive. They don't see what you do the rest of the month. They only see what it is on that date. And that balance really matters. Zero balance says zero usage to them. And so you're missing out on those utilization points. And that's really important in your score too. So they want to see you using the credit. You got to play the game to get the points. So.
And it is a game. That's one thing that I hear over and over again, is that like it's a game, and it's something that you got to learn. Like you have to learn how to play the game in order to win, right? So I think that's a good analogy. All right, moving on to the fourth and final red flag. This is the one that we consider to be most important, the number one thing that you really should look out for on your credit report. That is
timeliness of payments. Yes.
And so, and that's basically just like making your payments on time, right? It's as simple as that.
Yeah. I mean, that can make up about 35% of your credit score. Pay on time, because that, really factors in. I have seen upwards of 100 to 150 point drop from being one time late.
And it's going to factor for 2 years. So there's no such thing as a little late pay. It's really heavily impacting your scores. I have seen 150 point drop just from one late. And then they're very, very difficult to get removed. If there shouldn't be reported if they're not 30 days late. But if they're true 30-day lates, then they're very difficult to get removed. And that's something that we do, help with. But unless you have some kind of documentation that backs you up that it's not a valid late, the FCRA is just very strict with those, and they're tough to get off. They do factor for 2 years. So that first 12 months is going to be the hardest on your scores. From there, you get a bit of a break. It's going to still factor for another year, but not nearly as heavily. So mainly with lates, it's about letting it age and not having any more of them hit. But and then once you get to 2 years, it's not factoring much at all at that point. So
and then they fall off after 7.
So, yeah.
And so when you say they fall off after 7, does that mean that they completely disappear, Megan?
Yes. So yeah, they would fall off after 7 years. Like Amy said, like after 2, they're not making an impact, but they will stay on that, credit report, because that's like your resume. So it'll stay for 7 years, and then they'll completely fall off.
Gotcha.
They should fall off. Sometimes they don't, and you need our help, and we'll get them off for you.
We would be happy to help.
We're here for that too.
Yes. All right. Well, we're hitting that 30-minute mark here. I don't want to keep you too longer than I have to. Again, I want to thank both of you for your time coming and sharing your wisdom with everybody who's watching and everybody who will watch this after we upload it to YouTube. If you are somebody who is, again, wondering about building your score, fixing your credit, whether it's to get into a home or refinance for a better interest rate, we would love to talk to you. Whether it's to give you a game plan, give you some quick advice, we're here to help you. We know that credit can be confusing, scary, and that's why we exist. That's why we built a team to be here for you, to work with you, and to get you across that finish line. So feel free to send us a message on our Facebook page, My Credit Guy Credit Restoration, or you can always fill out our form at mycreditguy.com/u-made-it. So thank you again, Amy and Megan, for joining us. I really appreciate both of your time. And,
Yeah, it was a pleasure being here. It was a lot of fun.
Yeah, it was fun. I loved it. Loved it. Thank you.
Awesome. No problem. Well, you guys enjoy your day, and thank you everybody for watching. We appreciate it.
Bye.
Bye.
Hello, everybody, and welcome to another My Credit Guy episode of Making Credit Common Knowledge, where our main goal is to help you understand your credit and the important role it plays in life. Whether you need a better score to qualify for a new home loan or for any other important purchase, at the end of the day, we hope that the knowledge that we are sharing with you is not only helpful to you,